Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, July 1st. Wow, I'm glad that first half of the year is over, and you don't need me to review how ugly it's been in equities, in bonds, even in June, horrible in commodities. So we'll turn the page. We'll look at Q2. What do we have this week? We had some things go right and some things go wrong. Remember, we had that big move off of that June 16th low last week. We had that big move. Didn't get any follow-through this week. Would have, in a perfect world, liked to see some follow-through. We talked about that last Friday. That's what went wrong. What went right? Well, for the first time in the last 3 months or so, when we did get a rip higher, we didn't give it back plus. So we had some weakness, covered up a little bit by the last couple hours of trading today on Friday. Bond market closed at 2. Equities took over a little bit there. I discount much of that action heading into next week. So what are we looking for in terms of ideas? Healthcare continues to trade very well, specifically biotech. Interesting, right? Some of the worst performing sectors of the last year, not year to date, the last 12 months, are trading better. That's a check in the positive column. And believe me, it's one of few checks. So we've got to keep even keeled here. You know, I was talking to my friend Jerry. Jerry's a client, a lot of good insight, bright guy. And we were talking last week, and maybe it was the week before, during that June 16th week, and talking about positions and what we could do here. And Jerry hit me with an old line I hadn't heard in a while. He said, it's tough to bet on the end of the world, because how are you going to collect? And, you know, sometimes you just have to have a laugh and put it all in perspective. Talking about putting it into perspective, let's go to the first chart I want to share with you today. And it's about timing in the market. We've spoken in the past about short-term buckets of capital and long-term buckets of capital, and why trading one bucket of capital is very difficult, because it's difficult to emotionally handle the rips and dips on just one bucket of capital. I want to bring this to your attention on a risk versus opportunity. And you know, in the past I've said, in great markets, everybody's looking for opportunity and ignoring risk. In bad markets, everybody's looking at risk and ignoring opportunity. Well, what I've got here is some cost and gains from 2006, 2007, and 2008 for Apple stock. The reason I brought this up was, if you had bought Apple in January of 2008, right in front of a 50% S&P correction, and then followed up with a real ugly 2012, some real volatility and downside pressure in 15, fourth quarter 18, S&P down 15, Russell down 22, COVID, S&P intraday down 32, 33%. Now, we'll call it recession 22, S&P down 21%. Look where your long-term bucket is with Apple. Let's just look at that 117-2008 slice. You know, we're talking about real wealth generation, and doing it in the face of ugly markets. So you want to be able to keep a longer-term perspective on some names that you feel can be real wealth generators. So that's something to work on, keeping short-term and long-term separate. And if you do it with multiple accounts, that's fine. If you can do it emotionally, that's even more important. I want to bring up a second chart when we start talking about emotions. Peter Brandt, outstanding commodities futures trader. I was introduced to Peter through his book back, it had to be 10, 11, 12 years ago, Diary of a Professional Commodities Trader. And while an awful lot of the book focused on chart patterns and different commodity trades that Peter had handled over the years, part of it was on the emotions of trading. And I've found that Peter Brent on his blog really has that even keel going about his business day to day, month to month, knowing that as an outstanding trader, he's going to have tremendous bouts of drawdown. That's part of the game. Nobody that's traded for 10, 15, 20, 25 years hasn't been dealt drawdowns. I love what he says here. More than anything, trading is an emotional endeavor. Bathing in the regrets of wouldas, couldas, wouldas, shouldas is not a road forward to progress. Learn lessons, then move forward. Self-forgiveness is a trait mandated for longer-term success in market speculation. We've talked about that, right? We're not going to get every trade right. I'm not, you're not, nobody does. I like to say nobody does except the liars, right? So we move on. We move on to Q2. What we do know is there are names floating out there in the market that are going to provide the type of performance I referenced in the Apple chart. Remember, Apple's not the top performer during that period. I used Apple because they've been outstanding, and many of our clients are familiar with Apple. So keep that in mind. Keep researching. Keep looking for ideas. Don't get too negative. By the same token, you don't have to get too positive. Try to stay even-keeled. Enjoy the 4th of July. We're going to toss it over to John Mousseau. He's taping remotely this week.
Hi, it's John Mousseau. I'm the Director of Fixed Income and CEO at Cumberland Advisors. It is Friday afternoon on July 1st. This week in bonds, yields down substantially. The 5-year bond is now at a 288, the 10-year bond is at a 288, and the 30-year Treasury bond is at a 308. What does that say to us? That says that we are basically today about 2 or 3 basis points ahead on those bonds from where you started the beginning of June. More importantly, you are down 60 basis points from the middle of June on the 5-year and on the 10-year, and down about 25 basis points on the 30-year. What is driving this? The drive on this is fear of the Fed, fear of basically higher interest rates on the short end, and essentially the economy slowing down. So the Fed has basically raised short-term interest rates from 0 to a quarter up to where the base rate is now at 175. The Fed has vowed to go much higher to quash inflation. That has sent fears into the market that the economy is declining. You have seen it in the equity markets. The fact that bond markets have responded to this with yields coming down is really backing up what we have been seeing anecdotally. We have seen lumber prices come down. We have seen copper prices come down. We have seen trucking and shipping rates come down. We have started to see housing starts come down. In fact, housing supply is 18% ahead of where it was a year ago. So the old adage about nothing is like a cure for high prices than high prices is being backed up a little bit by the real estate market right now. Municipal bonds, yields are down fractionally this week as much as treasuries, only down 7 or 8 basis points across the board. It has meant that munis are more cheap now than they were a week ago to treasuries. We think the muni market is extraordinarily a good buy, particularly when you saw deals this week come at 4.25%, 4.5%, in some cases almost 4.75% on insured bonds. When you compare that to a long treasury that's at under a 310, that is remarkably cheap. And I think one of the differences this week is the fact that the deals, whereas they were not oversubscribed 1 or 2 times, they were oversubscribed in some cases 8 to 10 times. That tells you that the buyers are now starting to get out in force. They are realizing that the muni market is as cheap as it is, and they are in this really unique environment where issuers are a little scared because of the volatility in rates and want to get their deals sold. Underwriters are scared about having unsold balances, so they price the deals extraordinarily cheap. And it has certainly been a buyer's market for now. So it has been a great environment for us to extend maturities and extend durations, and that's what we're doing. When you're capturing 4.5% yields, you are talking about taxable equivalent yields that can be anywhere from like 7 to mid-8s depending on state taxes. So we think the muni market remains a very good buy. Taxable yields have come in a touch versus treasuries, but not much. They continue to be a good buy, with some longer taxable munis being well over 5%, 525, 530. We think that's an extraordinarily good buy. And we think we are in this environment where yields, treasuries, but certainly things other than treasuries, are high. We think they will be coming down, and we think inflation will be turning down. Certainly you can be in an environment where the economy slows down even as inflation is peaking, and that's an important thing to keep in mind when looking at the bond markets. We hope everybody has a wonderful Independence Day weekend. With all the consternation that goes on in our country, it's important to remember that none of this happens without our forefathers on July of 1776 committing to independence from Great Britain. And as John Adams said then, this will be a day that future generations will celebrate with vigor for many generations to come. He was right, and we are, and we hope you all have a great weekend. Thanks a lot.
Thank you, John. It's not too often that fixed income has the same dose of volatility back and forth as the equity markets. So that's been something you've had to work on day to day, week to week. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos. Have a great weekend.